morning, but let's welcome on board Dipan Mehta as well and ask him about how the market is faring and what's it looking like going forward. Dipan, hi, good morning. Thank you so much for joining us today. Dipan seems like in good stead. We've recovered about over 2,000 points from those March lows on the index alone, better traction for the mid and small caps, and now you've got the quarterly updates as well from at least some segment of the companies which are looking very impressive.
Yeah, that's right. I think that I'm a bit more optimistic about this earnings season than before, because I thought that because of the Iran war, you could see at least subdued performance for June quarter or be full 3 months of the Iran war. But that has not happened. And at least whether it's auto, whether it is the banks, even the real estate companies, select FMCG companies, I think they all have reported numbers. Pre-quarter releases have been very positive. So maybe this earnings season may not be as bad. And look, stock markets always track earnings and growth. And if this earnings season is decent and investors are convinced that we've gone back to the growth trajectory which was there before the Iran war, then I'm pretty certain that in a few months or so, the Nifty and Sensex may be trading at new highs. We just need to keep our fingers crossed that the Iran war doesn't erupt. There's no other geopolitical event.
Dipan, hi, morning. We've seen the Nifty jump nearly 8.5% from the March lows. Do you think there is enough steam with respect to the earnings growth, which we are talking about, to push the Nifty beyond 26,000?
Yeah, I think it's possible, but I think the real firecrackers and the outperformance will come in the small mid-cap stocks. And mind you, the mid-cap stocks, the mid-cap index is trading very close to its all-time high. If I'm not mistaken, just 3-4% off its all-time high. And that is where I think investors will make the huge alpha, because a lot of the large cap stocks in the Nifty 50 have now got into a kind of a structural slow growth mode. Like look at tech or look at some of the other businesses. I think they become pretty much mature. So I would look at small mid-cap stocks to really drive the returns and improve the portfolio quality. So on the whole, also, I still feel that there is space for Nifty 50 also and Sensex to move up. But the real gains may come in small mid-cap stocks, the defense companies, smaller real estate companies, even smaller software companies, I think have got better prospects than the large cap software companies.
But Dipan, the only concerning factor here is the divergence in private banks. And I was talking to Kunal as well on the charts here. Looking at the quarterly updates, while HDFC Bank seems to have woken up from its slumber, look what's happening at Kotak and Axis, though.
That's right, I think, but it's not so much off. No, I mean, end of the day, 2-3% here or there is okay. And Kotak Bank is known to be far, far more conservative, amongst the most conservative banks. And it should reflect in their NPAs as well. So, it's just a matter of time before Kotak also starts to deliver inline growth in deposit and advances. But, on the whole, in the medium to long term, I'm a bit circumspect on the banks because there's a high degree of competitiveness within the sector. It's become a bit of a red ocean. And, maintaining these kind of net interest margins and growth rates this quarter may be good. Next quarter, because of NRI deposits, also may drive the earnings over there. But I'm not completely happy with the way the industry is shaping up from an investor's perspective. There are very strong structural headwinds which will emerge maybe a year, 2 years, few quarters down the line, which may make this kind of a growth unsustainable. And now we've got competition from the PSUs also, and there's so much of action happening on the NBFC side as well. And at the same time, the kind of access to low-cost deposits is becoming more challenging because of the stock market. So there are many, I would say, very strong headwinds for the banking sector. So while we may have a good trading rally, I'm a bit skeptical about the medium to long-term prospects in terms of delivering returns, outperforming returns from the banking sector.
That's quite interesting, Dipan. So should a meaningful rally come even from these levels? Would you use that as a profit-taking opportunity and allocate those funds to NBFCs or any other?
First of all, banks, NBFCs are now, I think, about 30% weightage in the Nifty. So if you're benchmarking against the Nifty, then I would like to little underweight the banking sector. And yes, this particular rally may be a good idea to shift away from some of the banks into the multi-product NBFCs, where I think the prospects are better and the risk return profile certainly favors the investor.
Deepan, your thoughts on mid-cap IT companies? I know the large caps are not going to show much of a growth this time, but the mid-cap IT companies, the Coforge, Persistent, Emphasis, uh, and others, LTI Mindtree.
Yeah, I suspect that this artificial intelligence will create very few winners, and most software services companies may find it very, very challenging and the growth coming off. And there are hardly a handful of three or four mid-cap software services companies which come to mind, which I think can ride this disruption and maybe take advantage of it. And certainly, I would put Coforge, Persistent Systems. There's a company called Fractal Analytics also, which is totally focused on AI projects. Maybe Happiest Mind comes to my the kind of first response. And then there are a few product companies, like Orion Pro is there, NewGen is there, Oracle is there, and lastly, if you see last couple of quarters, Ramco Systems, which has been a multi-year underperformer, even there we have seen very good numbers coming through. So one needs to be extremely selective when it comes to software services companies. And there will be some companies which, because of their domain expertise or because of their position or their I would say, approach to projects and the size may make a difference. And I think that one should not completely abandon the sector, but selectively position in such companies where now valuations are reasonable. And I'm convinced that the names I just shared with you, of course, disclosure that we and our clients are invested in it, I think they can still sustain anywhere from 15 to 20% type of a growth, which is good enough, I think, from point of view of delivering decent returns.
Just looking at some of the other stocks that are in focus this morning, and of course, Titan, that's come out with a very strong Q1 update. The consumer business revenue has seen an uptick of about 41%. You heard from Kalyan Jewellers as well last evening. The consolidated revenue growth is approximately about almost 38%. The same store sales growth, about a 28% of an uptick. And then, of course, you've got trend wherein the Q1 estimates are slightly sub what the street was penciling in. They've added one West Side and 19 Zudio stores in Q1. That's the update coming in from them. And then Jubilant Foodworks, wherein Domino's India like-for-like growth stands at about 2.5%. The consolidated revenue at 14%. It's definitely subpar than what the street was anticipating. But just very specifically, Dipan, on the trend that we're seeing from some of the jewelry retailers, and I can't really call Titan just a jewelry retailer, but Titan's updates and Kalyan Jewellers?
Oh, no, Titan is a jewelry retailer. I mean, if you look at the numbers,
Well, large part,
main
yes.
profit comes from, yeah, 90% thereabout comes from jewelry. So I know they try to do many other businesses, but still jewelry, even at such a scale, remains the fastest growing division within the company. And look, it's very impressive what these jewelry companies are delivering. And that's clear reflection of the kind of consumer demand, the wealth effect, and the increased emphasis on fashion jewelry and higher spendings on wedding. And it's not just gold prices. I thought higher gold prices and of course the PM's kind of direction to cut back on gold, that has not had much of an effect, and these companies have still delivered stellar performance. Companies like Titan and Kalyan have even been able to grow their business overseas as well. So very impressive, and I think one should remain invested within the sector. As a measure of disclosure, we are invested in Titan and Kalyan and very pleased with the numbers which have come through. But at some point of time, the base effect will come into play, and then maybe next quarter, when lower gold prices start to filter through these companies, I'm not sure that these kind of impressive top line numbers we may see, because a lot of it is because of gold appreciation as well. But when gold starts to decline, you should factor in that the revenue growth may slow down. But again, profit growth may remain the same or maybe higher, because end of the day they make the money from making charges and a lot of other revenues and not just selling of gold.
Dipan, what's your view on QSR companies? Jubilant came out with numbers, top line up of 14%, but like for like growth has been very muted for Domino's.
No, our view on QSR is negative, and it's a sector that is being challenged by the food delivery companies. And I feel that companies like Swiggy and Zomato, they have a far, far better prospect than the QSR companies. These companies, I think, in terms of growth rates, single stock growth rates, it's extremely disappointing. And some of these companies have gone overseas as well to try and boost their growth. And that I don't think is a very sound strategy. So I would remain underweight in the entire QSR group. For many, many quarters, we have seen that the like-for-like growth rate has been flagging. On the other hand, you have got the likes of Swiggy and Zomato, which are still delivering exceptionally good growth rates as far as their food delivery business is concerned. And slowly but steadily, the quick service uh, business also is also delivering very decent growth rates, and at some point of time will break even and start to deliver solid profits. So I think it's better to be with these new age platform companies than the QSR companies.
Absolutely, makes sense. Second that point totally, Dipan. But let's take it across to Ashesha. She's waiting by with another list of stocks which are the movers this morning. And Ashesha, what's the list looking like?
Yes, first let's start with Varun Beverages, and this is on the back of an acquisition that its Kenya subsidiary has done yesterday. The company said that Varun Beverages Kenya subsidiary has actually acquired Devyani Food Industries Kenya Beverage. This is an about 350 crore acquisition, and it includes 52-acre manufacturing facility in Kenya, which is located strategically. So this is a big acquisition that Varun Beverages has done and informed the exchanges about. We also have Bluejet Healthcare that will be in focus on the back of their fundraising plans, where the board of directors said that they will be launching a QIP to the tune of 600 crore. The QIP will open today. The floor price has been fixed at 531.7 rupees per share, and this implies nearly 5.3% discount as compared to yesterday's closing price. So on the back of these fundraising plans, keep an eye out on Bluejet Healthcare as well. Meanwhile, we also have rights, and this is on the back of a big order. The company said that they've received a letter of acceptance worth about 342 crores. So keep an eye out on this railway counter as well. Standard Engineering, meanwhile, the company said that it will be investing about 70 crore rupees to acquire 19.2% stake in Japan-based GL Hako, and the proceeds will also be used to increase its manufacturing capabilities, and this is a part of larger roadmap for Standard Engineering back home in India. Reddington, meanwhile, will be in focus because they have earned Frontier Distribution designation within the Microsoft AI Cloud Counter program. And lastly, Dilip Buildcon, because they have received completion certificate for an order worth about 780 crores. So several developments that have come in with respect to order wins. Keep an eye out on Dilip Buildcon on the back of that news piece.
Thanks, Ashisha, for that. Deepan, how do you look at some of the defense stocks at this point in time? The government has started a OFS for Cochin shipyard as well.
No, I think defense still remains a very hot sector from an investor's perspective. The problem is that there are very few stocks which are in the large cap category. So good quality paper within the sector is quite scarce. There are hardly any IPOs in the defense space, and a lot of the listed companies are very high promoter holding. And then whatever is in the float that has been quickly acquired by outperforming mutual funds and influential investors. So I would say that remain invested, look for opportunities within the defense space. They do come from time to time because the earnings over there are quite volatile. So on a weak earning, if you get into a good quality stock, that makes sense to me rather than chasing them on such days, where they are up 4 or 5% or so. Also, I think there's a good trading opportunity in the defense companies. Q1 result may be quite decent for a lot of these companies. So you could have a nice pop on announcement of result. Some amount of pre-quarter buying also is taking place over here. At the same time, I think the way the government is going about and what the lessons we have learned from the Iran war and the Ukraine war, many new opportunities are also emerging for a lot of private sector defense companies, particularly on maybe drones or on electronic warfare or similar such businesses. So I think that companies are not able to grow in their existing products, and many of the private companies or private sector companies are also growing in new segments, related segments, and that also offers a good growth opportunity. And mind you, I think the industry as a whole has not even scratched the surface when it comes to exports.
Oh, yeah, absolutely. Those orders are just about trickling in right now. Let's take a very quick break on that note. When we come back, we'll continue our discussion with Dipan Mehta and Kunal Bothra both. But let's try and analyze what the foreign institutional investors have been doing. And they've actually turned net buyers in the second half of June. They've actually pumped in over 14,000 crore rupees into Indian equities. Now, call it short covering or whatever you may. And financial services emerged as the biggest beneficiary, while consumer services, realty and healthcare also witnessed strong inflows. Mithali, in fact, is here with the latest trends on what FIIs have been doing in India equities.
Rightly mentioned, the foreign institutional investors, they have made a strong comeback if you see in the second half of June, where they have invested on a net basis nearly 14,100 crore rupees in the Indian equity markets after selling a massive 51,500 crores in the first half of June. Now, despite this comeback, if you see on a net basis for 2026, they have actually remained net sellers in every month in the Indian markets. While if you talk about the DII's number, they have continued to support the Indian markets, remaining the consistent buyers for each and every month for 2026 till the month of June. Now, if you see based on the sectoral activity for the second half of June, that is from the 15th of June to till 30th June, the consumer-facing and domestic growth sectors, they are those sectors where they are attracting the foreign money. Consumer services in particular saw an inflow of nearly 3,000 odd crores, while construction, consumer durables and real estate, they also witnessed renewed FII buying. Healthcare also returned to the buying list, attracting nearly 1,435 odd crores in that second half after significant selling pressure seen in the first half of the month. However, the FII recovery, it was not broad-based. So if you see the foreign investors, they continue to sell the shares in metals and mining, oil and gas, power, automobile, as well as the capital goods. Metals and mining, they recorded the highest outflows, which contributed nearly 4,371 odd crores, following by power at 3,743 odd crores and oil and gas at nearly 2,800 crore rupees. Now, there was some relief seen for the IT sector, where the selling pressure, it moderated sharply. FII outflows declined to 733 crore rupees in the second half, compared with the massive outflow that we saw of 6,700 crores in the first half. The biggest shift which was seen in the month of June for the second half was in the financial services, where the FIIs pumped nearly 14,634 crore rupees into the sector in the second half, reversing the net selling of 11,263 crore rupees in the first 15 days of June. So overall, this latest FII data, it shows a selective return of the foreign capital into the Indian equity markets, with investors showing a clear preference for financials and domestic consumptions, sectors like consumer durables, and also remain cautious based on the global uncertainties that prevail.
From the Sizzlon Studios, we have with us Kunal. Kunal, how do you look at the market today? I mean, you have the expiry there. Is it a volatile day, especially the second half?
Yeah, in fact, the last couple of expiry days for the index, of course, last week was the monthly expiry also, has been a little volatile, and we've seen the index trading, the Nifty trading broadly into a 150 to 180 point range. That's the ATR, or the average to range for the index for the expiry days. So it's almost like a 0.7 to 0.8% kind of a move which we expect on the indices. So far, I think looking at the trend, there's been a bit mixed days for Tuesdays, because generally we've seen Tuesdays to be one of those odd days where the markets takes a bit of a backseat and then tries to come back into recovery for the remainder part of the week. But in the last couple of occasions at least, we've seen the markets to be slightly more on the bullish tone because of the overall market construct. So expecting, yes, the markets to be a little volatile, but hopefully we may close in the positive side.
Another stock which is, which we need to look at is the QSR stocks where, Jubilant is one of them. How do you look at Jubilant? How do you look at other QSR stocks?
So Jubilant Food apparently has been a big disappointment. From the point when the stock was almost at 750, I think in 2025, to being a point when the stock is almost at 420, 430, where it's trading right now. It's been a disappointing stock. There have been multiple phases where the stock has gone through after a corrective phase, a rally, but it's unable to really come back into lifting of any kind of a trend. Now, the only positive part when I look at the long-term charts for Jubilant Food is the last 6 months as a bunch. You've seen 2 or 3 weeks or 2 or 3 months where the volumes have inched up significantly higher for Jubilant Food. So maybe that tells you that there's been finally some sort of a buying interest into the stock price at the lower levels. We're looking at a point where this 430, 440 could be a good point where long-term traders could accumulate. But it's just that the charts for the stock are still making a pattern of lower highs and lower lows. We need to see a breakout into the stock price. As of now, it could just be a good value buy at the current price juncture. Looking at
and same store growth is 28%. So jewellery companies are seeing a good amount of traction, especially on the back of Akshaya Tritiya and festive season, which came in Q1. But also because gold prices have also fallen by over 20%.
Yeah, so I'm sorry, I lost you over there. What was the question?
Jewellery companies seeing good traction in this quarter on the back of good footfall, for lower gold prices.
That's what I think we discussed earlier in the show, that very impressed with the pre-quarter releases which have come from Titan and Kalyan. And, despite such a high base, previous quarters also were decent. For these companies to report these kind of growth rates is very impressive and shows the wealth effect and rising consumer spends on fashion jewelry and also wedding jewelry. So very positive. Valuations are still reasonable, but look, at some point of time, these kind of growth rates are not sustainable. And as gold starts to correct, we may see the impact in the top line of these companies as well, although the bottom line, may not show as much decline, because at the end of the day, the revenues and profits come from making charges and not the actual gold which they sell. So, that's a great investment. We remain invested in these companies. Great long-term plays also as the industry moves from the unorganized sector to the organized sector. So from that point of view, very positive, but one needs to temper the expectations going forward.
Dipan, thank you very much for joining in today. Let's move on to